Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today, we wanted to talk a little bit about the large cap holdings in our portfolios. We skipped our video in January because we had an in-person town hall type meeting with many of you. And we did discuss a little bit of large cap, although the focus of that conversation back in January was really more around bonds. But we just did discuss large cap. We continue to watch what's going on in the large cap space because a lot of you have significant holdings there, not as much as the rest of the population. Our portfolios range somewhere in the neighborhood of 12% to 30% in large cap, depending upon how risky you are and which model you're in. But we saw a pretty decent performance last year, Steve, right? A 16.5% return in the large cap holdings.
We
And
did. Yeah.
even year to date, it's February. It's February, the middle of February, and we do see a little bit of a bump with our large cap. I think it's somewhere in the neighborhood of 2.8%. So if you
Yeah.
extrapolated that out across the year, not bad, but maybe not as great as, for example, the S&P 500. And so we wanted to talk
Yeah.
about that.
And I just want to mention one thing that our large may not have as much in large cap holdings as a lot of other people. We do specifically treat and exclude mid cap from that. We treat it as a separate asset class within our model. So, many of you may have a allocation to mid cap from 7 to 15% in addition to large.
Right. And Steve, we should probably even just talk about why that's the case, because I think
Hmm.
we're trying to be very,
Sure.
very deliberate and make sure that there's always mid cap exposure, right? And small
That's
cap
correct.
exposure. Some people don't break that out, but that's a problem because sometimes if they're not paying attention, the portfolio can skew one direction or another. And we want to be very deliberate with the way we're approaching investing in the large, mid, small cap space.
And there's a reason for that as well, is that mid cap tends to capture a lot of the return of small cap stocks, but with a lot less risk. So you're gaining a lot of that extra performance without the enormous risk you have with small cap, which the risk for small cap could be at least double the risk of large cap stocks. So
Right. So this slide actually shows the performance from the beginning of the year. Again, we're only in February of the S&P 500, which is the purple line, which has delivered a return of 5.45%. Compare that to a lot of the other holdings. Some of you in the more riskier portfolios do have the pure SPY, as they call it, the S&P 500
yeah,
exposure. A lot of our less risky or risk adverse clients, we've tilted more towards value, and we still think that that's the right place to be, but they still have not actually performed as great as the S&P 500. So we have these different funds that we've listed here. The first one that performed almost, I guess the best out of the group is the revenue weighted. And so again, what we're looking at is finding exposure to the S&P 500, but with a parameter involved in um, telling us that that company has value. So one of the things
that's
that we're
right.
looking at is revenue. Are you producing strong revenues? And so that tilt is really important to us. We also like this Pacer cash cow because that has a heavy tilt towards free cash flows, which honestly, as business majors, anybody in the listening to this as a business major, cash is king. So the focus on cash
Right.
flow is really important to us. We then have companies that are focused on paying dividends, also a signal that these companies are strong and are able to pay and give money back to the shareholders, which is very important. And then we have just equal weight exposure so that we're making sure that everything in the S&P 500, all the large cap funds, we have exposure to.
That's right. And by the way, academic studies show that the equally weighted method of creating an index actually does outperform the capitalization weighted index, which is reflective of SPY's holdings,
Mm.
SPY. That's weighted more by the share price times the number of shares outstanding, and that's the capitalization number. And so what's happened because of that, SPY has become really overweighted to about the 5 to 7 stocks, which we're actually going to talk about.
Right. So the equal weighting is really the ideal place to be over the long run. There are
Yep.
times where the S&P breaks out and does really good. Oftentimes what we've seen is it's breaking out because there are some strong stocks that are really running away with things, and that gives us pause. And so,
Yep.
if you want to show
Yeah,
next slide.
we kind of feel we don't want to ignore that either, to Laura's point, because we know that the equally weighted may be great over the 20, 30 year period. We also got to kind of look at what's happening today. And so we also don't want to just ignore the fact that these 5 to 7 stocks have performed so well.
So this is the listing of the top 20 companies in the S&P 500 weighted by its their exposure to the S&P 500. And if you click again, Steve, you'll get the top 7. Some people have called the top 7 the Magnificent 7,
I hate that
because of
term.
because of how well they performed at one
Hmm.
point. Although Tesla has really been lagging behind, but the other 6 have been performing over the past couple of years fairly well. They were down in 22. Some of these were down by 50, 65%. Uh,
That's right.
but then they have started coming up, and some of them, particularly NVIDIA, has surpassed the downward trend, and it just seems to be running away with things.
And with NVIDIA's case, that's because of all of the excitement about artificial intelligence and the use of NVIDIA's particular chips that they manufacture called graphics processing units, and how applicable they are to that growing technology of artificial intelligence.
Hmm. And and so, Steve, we didn't put all the slides that we have available to
No.
kind of talk to this, because we don't want to make this overwhelming. But Steve and I have spent a lot of time looking at these different companies and
Yep.
the valuations behind these companies and their earnings, what they've historically produced in terms of earnings, and what they're saying they'll expect to produce in the future. And their valuations remain to be really questionable in terms of when we look at all the different valuation measurements, whether it's price to book or whether it's price to earnings, whether it's future price to earnings.
Yep.
And now it appears, as you were mentioning, Steve, before we got on this call, you've read some articles and we saw it in some of their PE ratios. All of a sudden, these companies are declaring higher earnings. And we aren't sure if these are sustainable. There's reason to believe that maybe they are not going to be sustainable.
Sometimes it just comes down to simple math. You can't have your earnings grow by 30 to 60% a year. When you compound that even over 5 years, one of these companies alone will probably reflect 30% of GDP. It's just simple math. When you keep constantly compounding something, it starts to grow in a nonlinear fashion, and it starts to grow like this.
Right. Well, one of the research articles even was talking about, for example, earnings. NVIDIA recently upped their earnings,
Yeah.
and they did an analysis where they said if, in fact, NVIDIA's earnings actually were reflective of reality, we would need our energy sectors and precious metals to go up by like 1,000 times. And they were just trying to point out the disconnects between what they think is going to happen and what really reality appears to be. And it's very, very difficult when you start pulling this all
Yeah.
apart to assess if they really can continue that level of growth.
Well, you mentioned an interesting point earlier, that the amount of energy, electricity used to power these chips would be overwhelming if this growth rate continues, and they would have to really dramatically alter the electrical generation infrastructure in this country to supply the energy demand that these chips will require to run all this artificial intelligence in these processes. It may change. They may become more efficient, but it's not on the horizon right now, I don't think.
And not to mention also the fact that while we do believe that artificial intelligence does have a future,
Yep.
obviously it's going to be here with us. The question is, what companies are really going to be the superstars in the next 5 years, 10 years in the
That's right.
artificial intelligence world. We saw that the early adopters, for example, with personal computers, some
Hmm.
of them went bankrupt within a 10-year period. They were not the superstars over the long run. So that's
Yep.
also, as we see the companies jockey to take leadership in that market space. We don't know that these are actually the ones that are going to drive it.
And I just want to throw this out. Remember Northgate Computer? Nobody does.
What? What?
Northgate Computer.
No.
They were one of the. I had a couple of their computers. They were one of the
Okay.
best firms,
I do
and
know Compaq was one of the best, and in
they were.
1995 they went under. So
Yep. And the other one,
1985 they were a superstar. In 1995 the company was completely defunct.
and Gateway, they had the cow spots all over their boxes. Remember? They're gone too.
I must have not been around then.
Yeah, you know they had they had those cow spots on their boxes because they were in the Midwest. I think they
Okay.
were manufactured them in the Midwest. Long
Okay.
gone.
Right.
So
I don't recall that. But anyways, the point of the matter is that we are concerned. These companies make up 30% of the S&P 500. And so they are driving specifically. NVIDIA is up something like 45%. Amazon is up
mm,
almost 15%. Microsoft is up 11.8%. I mean, these are big numbers. And so they're pulling the
yeah,
S&P 500 where we have exposure to those companies. We're not as overweighted in those companies purposefully because we are concerned about what might happen. And that is because we look back at history at times like this. And the last time we saw this, where there were a couple of companies that drove the S&P 500 so hard, was back in 2000, where we saw
yes,
the top 5 companies driving the S&P 500. Microsoft, interestingly, was on that list as well. And if you click, Steve, you can see that it's Microsoft, GE, Cisco, Exxon, and
hmm.
Intel. And they made up almost 20% of the S&P 500 back in 2000.
And God, what's happened to GE?
Well, yeah, GE has never come back. But if you even
No.
click on the next slide, this is a really, really interesting slide because in 2021, this shows the 4 companies. We didn't include Exxon on this because Exxon actually has done well, but those 4 technology companies that came down in 2021, and people say, oh, don't worry, I'll just ride it through. I
Hmm.
really have to question how many people rode this through because um, up until 2013, so 14 years later, those stocks were still negative. Now, after 2013, some of them started to turn positive, but still for 14 years, they never came back. And that is
Yeah,
because they were so overinflated in terms of their price that it just didn't make sense. Microsoft had to grow back into its pants, really.
they did. And if you plot, we didn't, but if we plotted the S&P against this, you would have seen the enormous growth in the S&P as a whole over these years, which shows once again how difficult it is to pick individual stocks and think that you're going to pick the winner. It's not easy.
Hmm. So, once again, we wanted you to get a sense of how we're investing in the large cap space. We do have exposure in some of these companies, but we're exposing you to them in a very thoughtful manner, looking for companies that truly have value. And even if we do have some kind of dip, and we still don't know exactly what's going to happen over the next year or so, there's a lot of moving parts and indications that we may still have a rough road. But even if we should have to endure something like that, we're in quality companies that have value and are, even if they go down, our expectation is that they're not going to stay down like this.
That's correct. And our holdings in 2022 were down about 4 or 5% less than the S&P as a whole. So we've have tended to go down less than the S&P in general because of the nature of the holdings we have.
Right. And that's just large cap asset class to large
Yep,
cap asset class. We
only.
actually were significantly less down as well because of the asset allocation, but we're just comparing that one sliver asset, the large cap asset class.
That's exactly right. Yep.
So, once again, thank you for listening to us. We're hoping that we're providing you with information that is valuable to you. We did want to make a mention that many of you did donate some money to various charities based upon our incentive to help you do that. And we're very proud of you. We think that we've made a difference in what we've done. Um, and we hope to talk to all of you. But if we don't, please do us a favor if you can and like our YouTube channel and subscribe to our channel so that we can keep maintaining it and keeping you informed of what we're doing. Thank you and have a great day.